And so I won't talk on the actual result. I'll leave you to read through that. But what moved the stock on Friday up 40%, I think it was the trading update. So we were all sitting there, fearing what would be quite a negative trading update, just given their key competitor with 40 stores had rolled over in the last couple of months. But what we'd also kind of figured out talking to a lot of suppliers is that because they went all to cash on delivery, 6 months ago, the stock had actually wound down quite a lot within those Babies R Us stores. So clearly it ended up having a very limited or muted impact on Baby Bunting. In fact, nothing. It was quite a strong period for them with the comps up 10%. As we said, when you come out of a bad year and you've got a 6% EBITDA margin, which isn't a lot, this company is so sensitive just to the smallest amounts of GM recovery and operating cost leverage, which is coming through. So they've come out and guided for 30 to 45% growth next year, which we'd already had a big growth number, but it certainly surpassed our expectations. Importantly, they came out and put into context all their peers that have gone into receivership in the last 12 months. So they've penned that at about $140 million of sales have left the industry. Now, Baby Bunting did around 300 mil of revenue last year, so that's 45% of their current revenue is up for grabs. If we're a little bit more cautious there and say, well, let's look at the products that really are overlapping and the Babies R Us stores and their competitor stores that are actually in an existing Baby Bunting catchment. I think it's more like a 45 to 50 mil near-term opportunity. Baby Bunting has around 12.5% share of the market at the moment at $2.4 billion industry. I think that can at least double. This is now a category killer in line with, the Bunnings of the world out there. I think that market share can at least double. They reiterated their EBITDA margin target of 10%. Now, we were well below that, still are. In fact, our EBITDA margin forecast now doesn't get to what they delivered in FY16 until FY21. So, look, I just think we're in for a multi-year, very, very strong earnings recovery here. I think earnings risk is certainly to the upside in relation to my numbers. We've got around 29% 3-year EBITDA CAGR now, and we're not pushing this. So we're getting back to basics with a 6-store per annum rollout. These guys have less than 50 because remember they IPO'd at quite an infantile position, and just modest, GM recovery and OPEX leverage, and it gets you to very strong growth. So well above what we're going to see from the rest of the retail sector. So we've increased our price target to $265. We left the ad there. I think it continues to go up. To be frank, the PE will look, quite stretched, but it needs to account for the fact that I think there's still significant upside to, I guess, the runway from growth and how quickly that comes through as well. So, it did good work on Friday, but, I think you at least hold in and you can probably keep chipping away.